Hello, everyone, and welcome to another episode of the Rodcast. Today, we are going to be doing I say quarterly, it's been a while since we've done this last, our Resi market update. Now, if you haven't listened to one of these on the Rodcast before, you will be best off doing so, or actually watching it through our YouTube channel. So if you are listening, go onto the show notes and there'll be a link for the YouTube and just head over there. There's lots of graphs and charts that we're going to go through, so it's always probably a bit better to watch this. If you're in the car, listen. I'll try and remember to explain what's happening in the graphs, but we'll see how we get on. So, our Resi market update. Now, before we start this, I just want to let you also know about an event happening on the 22nd of January 2026. It's myself and Adam Lawrence are hosting, I think it's our ninth property business workshop. We do one of these every quarter. As it's January, we're going to be doing it on productivity, um, processes, systems that we use for a bit of efficiency for SME businesses that are trying to scale up, so property businesses, that is. And we're also doing it on financial understanding, so getting your books in order, understanding what you should be looking at as a property investment business in terms of those finances and what you should be tracking. So please do check out the link in the show notes for tickets for that. So, our Resi market update. I'm going to talk about rents, house prices, affordability, supply and demand, factors affecting those house prices, and all the data that we use is from the likes of the ONS, HomeLet, Dataloft, Zoopla, Nationwide, Rightmove, Halifax, and many, many more. And as we go through, I'll kind of explain where this data comes from, why we prefer maybe some data sources over others for certain metrics. All of them have pros and cons. Like anything, there's good and bad parts to all the different data sets, but the key is to understand the context of them. So, if we get started with our UK rents and house price inflation, this one is from the ONS and it is for showing the private rent and house price annual inflation up to September 2025. Now, what we can see is that monthly rents, according to the ONS, have increased at a rate of 5.5%. So they're now on average £1,354 a month is the average rent in the UK. Now, that growth is down from 5.9% in the 12 months to July, and it's been going down ever since. Obviously, it's still growth, it's just the rate of growth is slowing for those rents. Okay. Um, Now, if we look at that depending on area, what we can see is actually the biggest rate of growth, according to the ONS, is in the northeast. We've got London kind of around the middle, actually, not doing too bad at about 5%. Northeast is up just over 9%. And the worst performer is Yorkshire and the Humber just under 4%. Okay, now remember, this is the ONS. Now, the ONS tracks data from land registry mostly. It tracks rents that are total market rents. So it's about 500,000 rents that they look at. It's not as big a sample as some things that track rents that we'll move on to in a bit, but it is very accurate, the data. It's not making any assumptions, but it's backward looking. So it's all quite slow. It's also a lot of existing rents, and we know that majority of landlords are not putting their rents up every year. They wait till they've got a new tenancy. And so often the context around that means it's quite lagging. We can see the house price inflation according to the ONS. Again, the Northeast has got the biggest percentage increase at about 6.6%. London is actually decreasing in price. So it's just not quite -1, but about minus zero point 0.2, I think it is there on the ONS. So there's quite a big difference depending on where you are around the UK. Now, if we look at something like HomeLet that uses data from Dataloft, now they get their data from new lets, and what it shows is they're looking at kind of referencing systems, and it's great because you actually see how much money is in people's banks and all that kind of stuff. So it's a really useful data set, and it's current. So this is all about new rents and new tenancies that are starting. And what we can see here is that actually the UK is a very different story for new rents. It's 0.9% growth and only 1.5% on average if we exclude London. Okay, so that's very different to what the ONS is telling us. And what we tend to see is actually in about 6 to 9 months' time, the ONS figures seem to catch up to where the home let and data loss figures are right now. So if we spread that around the country, what does it look like? Well, actually, the Northeast is showing being the worst performer. Okay, so minus 1.9%, so negative growth of 1.9% versus the ONS saying it was just around 9%. So that is a massive difference in terms of data that is essentially, on the face of it, meant to be showing the same thing. So again, context is massive there. Greater London, we've got is just well, basically stagnant. Is 0.1% decline in rent, and I think the ONS had it at around that 5% mark. So what we can see here is, although we've had some good growth, now we've got it pulling back a bit. So rental growth has dramatically reduced to the 5-year average after sort of two very strong years. Biggest reductions this year are in the northeast, the southwest, and London. East Midlands still doing okay, 3.4% growth. Yorkshire, 3.8% growth. Northern Ireland's bashing it out the park at 7.4%. But you can see there the direction of travel is very different to what the ONS is telling us. And typically, what we'll see is the ONS 6 to 9 months will probably be about where we are. So that's normally what tends to happen. So yeah, we another graph basically just showing the same thing, really, showing the trend and the decline coming from most of these places, with the exception of kind of Yorkshire's popped up a little bit, and we've got the obviously Northern Ireland was doing very well as well. So the average UK rents of new lets are 1,343. Now that's up in over 5 years by about 23%, or annualized, it's about 4.2% year on year. Now it's quite important to note our start and finish date here. So we're looking at October. Now, this October has not been a very good October, but the October in 2020 was exceptionally good. So actually, if we you're cherry picking your start date can be quite interesting, because if we just took it back 6 months, it would probably be about 38%. So you've got to take everything with a pinch of salt, but it's why we'd like to work on long-term averages, because then we can get over 5 years. That tells us a lot more than just one difference in a year, because a year doesn't tell us the full story, doesn't tell us the whole pattern of where things are going or trends. So in London, we've got Hackney and Newham with the biggest gains with 8.3% rental growth, and the biggest loss was Camden with 9.7%. So again, that sounds pretty dramatic with Camden. It was even worse a couple of months ago. It was over 11%, I think 2 months ago. So it's getting better. What we're really seeing, what this trend is showing us, is we've had some big gains in London, and that is really stabilizing now. I say stabilizing, stagnating is probably a better word. So although we've had some huge growth, it's been limited now, and really what we're starting to see is rental growth in those areas of higher value have reached a ceiling, and they've reached an affordability ceiling, and we'll go on to that in a bit. Well, we'll go on to it right now, because here's the next graph showing affordability over the last 5 or 6 years. And what it's showing is the average proportion of gross income that a household is spending on their rent for tenancies that start every month. So, at the moment in the UK, the average for September 2025 was 32% of a household's gross income being spent on their rent. Now, in London, that is 38.3%. Now, it's always going to be higher in London because it's a higher value area. And when you look at staples of living that we spend our income on, they don't really tend to change dramatically depending on where you are in the country. So, clothes, transport, food, think those staples will remain pretty stable depending on where you are. I mean, you're going to shop at Sainsbury's or Tesco's or Waitrose in all those areas, aren't you? Whether it's in the northeast or in the southeast. So what that's why they don't tend, but we do have higher incomes in London. And so typically your housing cost will be a higher proportion because actually what's left over can still pay for those staples of living. So that's why, and we see the same on house prices with mortgages as well. First time buyers can spend a lot more of their income servicing their mortgage in London on average, or in higher value areas on average than they would do in the rest of the country or lower value areas. Okay. So what we can see here is actually it sounds quite high, but it's got more affordable than it was. So we can see actually even in September 2023 it was slightly more unaffordable than it is now. So things are stabilizing. One thing this doesn't show is its gross income. Now, net income is actually the really important thing, and how things are changing is we've had inflation over those past 5 or 6 years, but one thing has remained the same, and that is tax bans. And so, actually, the fiscal drag is making this more unaffordable. So, I think there's a little trap here that people are maybe not seeing when they're looking at this data, and that is that inflation and fiscal drag is starting to bite. And what you'll see is, although these figures do look slightly less than a few years ago, really, when we take into consideration that fiscal drag, this will be worse because the net figure after tax is going to hurt those higher earners. And even you might think, oh, well, poor them. But actually, if you're in a higher value area, yes, it will really affect you. So there's something to be careful of there. So 32% of income was spent on rents in October. That's down from 32.6% a year ago. So it's slightly more affordable on average, but again, that's gross rents and it's not the net. But there are differences between areas. So the greatest change in the last year has been the Northeast. Again, it's popping up. Okay. Rents are down 2.8% of a renter's income. Okay. So it's actually more affordable in the Northeast by quite a big chunk. 2.8% of less of a renter's income is going to be spent on their rent. Now, that's also exactly the same figure as in Wales. So that's a really positive thing for those in the northeast and Wales. Why might that be? Well, we've had things like minimum wage go up. When you've got lower value areas, it just takes the floor of the value chain to move up to make a big impact. And so actually, it's been very positive for those lower value areas. So that's great. Um, it doesn't, like I say, factor in fiscal drag of tax thresholds, and I'm going to keep banging on about that because I think it's a really, really big point at the moment. So, yeah, we can see it again. The Northwest and the Southwest are the two areas becoming the most unaffordable at the moment. Yeah, so don't focus on value, focus on the percentage of someone's income that can be spent. And so we are actually seeing Southwest and arguably the Northwest is pushing up there. It's still not in concerning figures, though, for me, really, yet. So what about room rates? It's important to look at room rates. So this is kind of HMO room rates. And here we've taken some data from the Spare Room Index, which is a superb index they do every quarter. Um, why do we look at this? Well, tenants are the most transient in rooms, okay, rather than a three-bed semi-detached house. So it means they move quicker, and that part of the market tends to move a bit faster, and we can use it as really a leading indicator to what can happen. So we can see that rents have risen for rooms just under 1% year on year, so not a lot. Yeah. pretty stagnant there. London's rents have actually had a very slight drop as well. So not great news really if you're a landlord with room rents there, hoping to push them up. In Wales, however, it's been 2.3% increase. That's the highest year-on-year increase. The Northeast has been minus 0.4, and Northern Ireland the same as well. So again, it hasn't been a great year for room rents. London room rents have, however, increased 6.4% year on year when we look at the 5 year average. Okay. But again, if we look at the rest of the UK, that's up almost 9%. So again, that's a great example of why year on year isn't that useful, but looking at the 5 year term is. So again, quite interesting there. Now we've got some LHA rates, and I like to put this up just to remind everyone what your kind of base case should be if you're an investor. And remember, these have been frozen from the 1st of April 2024, so they haven't gone up, whereas everything else has. But I'd be looking at these and always kind of stress testing that disparity between what you're currently renting your properties for and what the LHA rates are. So you can see there, kind of, I've put in London's one, but you can go online. I'll try and put a link in the show notes where you can click on it and it will give you every single local authority LHA rate as well. So we've got Inner West London, for example, one room is £757 a month. A one bed flat is 1,346. Two bed, 1,620, and it goes up to a four bed, which is 2,543. So what about rental supply and demand? Okay, so we've got a Zoopla um, chart here, which shows where demand is. Okay, and it's showing pre-pandemic in the grey, and in the pink and purple, it's showing kind of 2024's level. And what we're seeing is actually demand has dropped quite heavily in terms of rent, and supply or the stock of homes for rent has actually gone up. So what we're seeing is the amount of homes available for rent has shot up at the same time that demand has crept down. So that's probably going to be a surprising one for a lot of you listening. And the reason for that is we've had a lot of build to rent come online. We've had people moving back in with parents and all that sort of stuff. It is an interesting one there. So, homes available to rent have increased across all regions compared to last year. Supply is up 36% in the southwest and 31% in the East Midlands, so massive. London, however, is bucking the national trend. We'll probably get into this later. Rental supply in the capital is just 6% higher than a year ago. So that is fairly woeful for London there. And it means that there's not a lot of supply for the growing London population of households. And we try not to focus on population. What we try to focus on is numbers of households. So investment levels are lower. Average yields are at a modest 5%, okay, which doesn't look bad historically speaking over sort of 10 years, but actually when you look at it against risk-free rates, then yeah, it's a bit of a squeeze. Landlords are buying with a mortgage also face higher barriers because they need a much higher deposit compared with, so for example, in London, you might need a deposit of 187 grand compared to 29 grand in the northeast. Yeah. And London's got the highest proportion of landlords looking to sell. 31% of homes for sale were previously rented, which is obviously putting a bit of a stickler on rental stock. And that's maybe why a lot of that supply of rental stock has shot up as well. Well, actually, you'd think it would reduce, sorry, wouldn't you, if they're going for sale? But what tends to happen is they go for sale, they realise they can't sell them, and so then they come back and rent them. Right. UK mortgage payments as a percentage of take-home pay. Um, so what we've got here is one of my favourite metrics there is. It is a graph that shows the percentage of a first-time buyer's income that is spent on their um, mortgage costs. And this is such an important factor for affordability. And what you also tend to see is when this rockets up like it did in 1989 and then 2007, what we know is right after that we had some house price crashes. So it's a super metric to keep your eye on. Um, the papers and the media often talk about kind of what a house price is as a multiple of people's incomes. That's not a great metric because not everyone's buying in cash. And so actually looking at affordability in two parts. First part being what is someone's upfront costs. So it's off the top of my head, I've got a slide on this later, but I think it's just over 100% of someone's kind of annual income goes on those initial costs of a first-time buyer, and then it's the servicing costs that are really, really important. And what we can see by my crudely drawn graph is where things have crept up to over the last few years. And I'll go and I'll speak in a bit about kind of why that might be or might not be a problem. So here we have that same metric, but based on different areas of the UK. So again, we can see London much higher than everywhere else, but we spoke about that. We expect London to be a higher percentage of first-time buyers' income going on their housing costs, whether it's rent or whether it's servicing the mortgage. And we know that because those are other staples of what we spend as a household really don't kind of have a massive change depending on where you are in the country. Okay, so what we can see is the red bar here is showing current levels, and the grey bar is the average of the last 50 years. And this data comes from Nationwide. It's super. They release it every quarter. Really, really useful. And what we can see is pretty much everywhere, with the exception of North England and Scotland, is less affordable on that metric for buyers or first-time buyers. So, what does that mean? Let's put that into context. So, the UK average now is 33.8% of a first-time buyer's income spent servicing their mortgage. And London's average is 55.6% of their first-time buyer's income is spent servicing their mortgage. Now, all of these are actually down from the Q4 in 2023, where the UK average was 38.4% and London's average was 64.3%. But what was it when we had actually house price crashes? So previous house price corrections of 19% in 1989 and then 15% in 2007. Okay, so the UK average was 45% in 2007 and 61% in London. So you might think, oh, London could be a bit iffy there. Now, in 1989, the UK average was 48% and London was 79%. Oh my goodness. Now, to make sense of this, we've got to look at what the reasons are. Now, 2007, there was a liquidity issue. We don't have a liquidity issue at the moment. So I don't think that's as relevant. 1989, we had rates shooting up. So you've probably all met some old geezer down the pub that tells you not to worry because in 1989 his rates had shot up and were, I don't know, 17 or 18%, and actually 4% or 5%, whatever you're paying on your mortgage now is nothing. Well, the issue is the velocity at which it goes up. So they were high in 1989, but it only went up for about 15%. So the velocity or speed that those went up and the margin, so the difference between 15 and 18% is not very much. It's kind of, I don't know, my maths isn't good enough, but about 20% increase. Whereas when we went from 0.25% up to 5% in the matter of about a year, that is astronomical. So that's a big difference. So 1989 is certainly more relevant, but we can see it went up to 79% in London. We're at 55%, so we're a bit of a way off there. We're a bit of a way off. That's not to say it's not going to be impactful. So for a 20% deposit for a first-time buyer, it equates to about 105% of their average annual gross income. Now, note, I keep flip-flopping between gross and net income, which isn't helpful. What I'd love is to have the figures for net income for this. Unfortunately, I can't get hold of it. This is from the ONS, and they do it on gross income. But as we've said, 105% of gross income 5 years ago will be much, much better than 105% of gross income now because of those that fiscal drag and those tax thresholds staying where they've been. So the peak of first-time buyer deposits as a percentage of their income was about 116% in 2022. So it's high now, it's higher than the average, but it's not as high as it's been. And again, averages not always helpful when investing directly. And so here we've just got a graph of house price growth. Okay, you can see obviously it's rocketed down in 2008. This doesn't actually show 1989, where you would see it go down about 10%, and then the next year it would stay down, the next year down about 5%. So it was always negative for a much longer period, whereas 2007 shot down and shot straight back up again. So it was short and sharp, whereas 1989, 1990 was a lot more drawn out. Okay, so take from that what you will. Are we similar to that point at the moment? We're probably more similar to there than we are kind of to the GFC. So not that it's the same. So all the indexes, and they are all different. So ONS again is quite lagging. It takes it from the land registry. It's probably about 12 months, maybe even longer out of date. Zoopla and Rightmove are a bit more kind of forward looking. So they're looking at things that aren't definitely kind of happened. So there haven't been sales, but they are looking at kind of what's going on in the market. Nationwide and Halifax, it's just a proportion of their own loan books. So back in the day, Halifax was typically the northern end of the country. Nationwide was the south. Now there's no real difference. They're all over the place. So give me 1 second while I adjust my camera. And I'm going to talk to you about distressed sellers. So we might be thinking, oh, mortgages have shot up. Everyone's going to be panicking now. People can't afford it. Well, let's put into context what the UK sort of housing market looks like. We have about 25 million households. Remember, households is the key, not population. About 36% of those houses are owned outright by owner-occupiers. So that's about 8.8 million. So that's a high number. If we look back to 2007 and 1989, it's much, much higher than we are now. We've got 6.8 million of them, or 28%, are owned with a mortgage or a loan. And about 4.8 million are privately rented. Okay, so that means owned by landlords. Now, about out of those landlords, there's about 50% of them that are owned outright. So that might surprise some investors. Yeah, about 50% have no mortgages of the privately rented ones. And about 4.2 million or 17% are socially rented. So housing associations, local authorities. Well, hardly any local authority stuff these days. Value of housing in the UK is about 8.25 trillion pounds. It's a massive market and it's got 1.675 trillion of outstanding debt. So our loan to value is pretty solid. It's pretty good in the UK. It's much, much different to when it was in 1989, 1990, and also 2008. So it's a much healthier market. It's much less risky in terms of its loan to value. About 5 to 7% of all mortgage properties are coming up for renewal in the next 12 months. Now, already most of them, since sort of the crazy Liz Truss budget, we've had a lot of people come through. Okay. Oh, 1 sec. It's always fun doing these at half term, isn't it? So we have had about 5 to 7% all mortgage properties come up for renewal every 12 months. Now, most of those, or I'd say most, yeah, just over 50% of those have already happened. So they've already had to take that bite and pay a bit more on the mortgage. Mortgage approvals are up by 45% from a year ago. Okay, but they are in line with the long term, sort of long term, the 5 year average. Okay, There's been some recent changes to lending, okay, loosening some of the rules as well. So, on the whole, that all looks quite healthy, okay? Don't get me wrong, if you've got to refinance now and get a new mortgage, it's going to hurt you. Yeah, you're going to get hurt, and the people that are going to hurt the most are those in the higher value areas, because you're going to be seeing you're in some cases the cost of your interest doubling, which is not very fun and it's tough. But on the market as a whole isn't as bad. Okay. Right, we can see annual price changes. This was up to July. I've taken it from Zoopla and I've left it in, although it's a little bit dated now, but it just gives an example of kind of the differences between flats, terraced houses, semi-detached houses and detached houses. So we can see that semi-detached houses have done the best, flats the worst. No surprises there. Flats have had a tough old time. In fact, if you go back the last sort of 10 years, it's a similar story. Flats have struggled a bit. They're always going to an extent. Things like leasehold, freehold issues, but also the big one has been the cladding stuff. And so that's left an awful lot of stock coming to market that people have been sitting on trying to get rid of for a few years. So, what needs to happen? House prices either need to fall further, or mortgages need to fall in terms of their servicing costs, or the big one is net household incomes need to increase. Okay. Now, what we are seeing is household incomes are increasing, but that's the gross. Okay, so what we really need to see is the net household incomes increasing proportionally with everything else. And we'll talk a little bit about that later. So that would just reset affordability and keep house price growth positive. Now, to be honest, affordability is not crazy now. It's not as bad as it's been over the last couple of years. Okay, so but long term wise, we could do with some productivity in terms of net household incomes going up. So number of homes to sell is high. Okay. If you're a seller, you've got to price it competitively because there's a lot of competition. It's definitely a buyer's market out there, and it's likely to keep price growth kind of low, really. Mortgage rates are obviously a massive factor. Recent kind of rumours around the budget are not helping. That's going to happen in November. Another factor is also wealth transfer. So we've got baby boomers, unfortunately, kind of getting to that age where starting to pass away. Um, what typically that wealth would transfer and people would put it into housing. At the moment, what's happening is with the previous budget, we're seeing a lot of more people falling in, well, not just previous budget, but also fiscal drag. We're seeing a lot of people fall into IHT now. I remember they used to say something, don't quote me on the stats, but it's something along the lines of kind of, oh, only 4% of people that die will be affected by IHT, and now it's something like 9%. It's gone right up because of that fiscal drag and inflation. And so what happens is it's having a disproportionate effect on higher value areas. So it's the high value areas that are really suffering at the moment in terms of price growth and rental growth. So earnings. Earnings are up 5%, okay, which is great, isn't it? But that's gross earnings again. So it's higher than rents, well, higher than new rents anyway, not existing rents as according to the ONS. It's also higher than house price growth. But to be honest, they had to be because that's rebalancing the affordability from a year ago when it was less affordable. Um, does this mean things are going to shoot up yet? Well, again, it's about the fiscal drag. It's about the what does that look like net after tax? And what we're seeing is an awful lot of households are being pushed into those higher earnings taxes. So, an example of that, if you're a higher earner, let's say you're on 80 grand a year and you get a 20k bonus, okay, or 20k increase. Um, so £1,000 a month ends up, uh, you kind of think, all right, okay, I've got 20 grand a year more. Um, it's tough because after tax and after you look at what proportion of what's left over can be spent on an increase in rent, that ends up for being about £350 a month for a 20k bonus. going towards rent. So it might sound a massive bonus and a massive increase, but in terms of housing and what people can afford, it's not huge. So again, that's looking at kind of rent being 35% of gross income. It's far more for net. So it's 35% of gross income, but for your net income, especially if you're a higher rate taxpayer, gosh, that's way more. And I'm not clever enough to do the maths in my head, but it is definitely a lot more. So, what can affect the market? We know it's availability of credit, things like affordability. We've kind of discussed that, but what's going to affect that, we'll go into. Government intervention, people don't put enough emphasis on this. We've seen how impactful policies can be. We've got Trussonomics, Michael Gove meddling with planning, Reeves's budget. I mean, it is big. And then after that is supply and demand. It's not as important as availability of money, but with a growing population of households and not enough houses, it can help prop up housing, but only up to that affordability ceiling. So, what does affect affordability? Earnings per household. That's the key one. We want earnings per household to increase if we want pricing to increase. Okay, needs to catch up or come down, and we're talking about net there, aren't we? Yeah. So the size of the household and the amount of earners in it, also that makes a difference. Yeah, the amount of earners in a household has been growing over time. Mortgage terms, how long is that loan stretched over? If we look back 40 years, typical first time buyer was about 20-year term. Now it's 40. Okay, so that stretches it over. It means they can afford to pay, they can afford to borrow a lot more because their payments every month are going to be lower. And also the amount of equity available, or what proportion of the price can people afford to borrow? Okay, that's the other big one. So if they have a windfall, if they've got good savings, it makes a massive difference. And then obviously mortgage interest rate. At the moment, it's stagnant. Hopefully, there's no one kind of sitting there waiting for rates to go down. Ever since Liz Truss, we were kind of banging the drum for don't do that because we don't think they are going to go down for a long time. At the moment, it looks like we just need an event, an economic event. So some sort of crash would be the thing to cause that. At the moment, we've got inflation still up high. Productivity is not great, but inflation is the key thing there that the Bank of England are going to be focusing on. And really, we're looking at the gilt markets because there's not a huge amount of the population on variable rates and base rate trackers. Most people are on fixes. So it's really, look, whatever the Bank of England does, is what the bond market cares about or what the gilt yields are going to be, because that's really what matters for us. So, what about inflation? Okay, we got CPIA, so CPI and housing costs and owner-occupier housing costs. Owner-occupier housing costs is always a bit of a funny one, the way they calculate it, but it's useful to have here. And what we can see is the owner-occupier housing costs have actually dropped over the last year. They were shooting up and they've dropped, whereas CPI and CPIH have shot up a little bit. So yeah, CPI up to I think that was the end of July or August was about 3.8%. It stayed pretty stable, about 3.8, 3.9% last couple of months. CPIH has been up. Owner occupier housing lowest for 2 years, but housing and household services has been up at 6.1%. So that is a bit of a concern as well. And then you've got education and communication scoring high as well. So when you look at the CPI, look at it broken down into segments. It's quite interesting. So what's going on in London? Well, not an awful lot, unfortunately. We only 1,000 units started construction in the third quarter in London. Now, people are going mad over this Mollier report, which is superb. I'd just say, just bear in mind that they only look at housing starts of 20 units or schemes 20 units or more. What a time for small schemes to kind of get on. They're not going to make a massive impact, but if you are, or if you're listening to this, you're most likely involved in SME property. So yeah, it's a good opportunity there. 281,000 unbuilt permissions. Again, if you're not in property, you might think, oh my goodness, is that land banking? No, it's not. It's just we cannot. house builders are not going to build if they can't sell them. So what we typically look at is big schemes. You need to pre-sell about 30% of them. And of the large schemes, about 30% of them as well need off-plan sales. So most of those are in London, and so developers are not going to build when they don't have those off-plan sales. It's going to be hard to get the funding out, and it's just not going to happen. Also, 90% of these London ones are high risk buildings. So, high risk building is anything that is over 18 meters or 6 stories or more and has two or more units in. So, a lot falls into that, and it just means that they fall under the building safety regulator regime and go into these ridiculous kind of what do you call them, phase twos and threes and things like that. So it's a bit of a nightmare, and that really is making it difficult for developers to build, to be quite honest. So policy is really deterring developers, but it's also deterring buyers. So the typical people who would be buying these are no longer wanting to. A lot of foreign nationals or foreign money would want to be investing in these, and at the moment, where you've got the rate of stamp duty as it is for people outside the country, it's incredibly restrictive. And so that is a concern. Also, build to rent's having a tough time with higher gilt rates. Investors are looking at kind of the spread between those and build to rate returns, and it doesn't look appealing. So it's hard. Institutional capital wants stabilized income, but it wants it to be competitive in terms of its return and risk. So when it says stabilized income, that doesn't mean buy to let stock. It doesn't mean our kind of typical existing homes. But is that going to change? Are we going to start seeing much more institutional capital come into that secondary market? At the moment, it's not. Although we did a great episode a few months ago with G2M, who does have a bit of institutional capital for just that. So maybe they're going to be the trendsetters and start and the catalyst to more institutions wanting to invest in it. Hopefully. So adjusted brick deliveries. There is a great guy online who puts out some fantastic stuff. Noble. And he regularly, he's the one who got me into seasonally adjusted brick deliveries as being a great proxy for housing starts, and that's up 12% annually. However, last year it was so low. So again, going up annually, looking at what it was compared to last year, not always helpful. It's incredibly poor at the moment. It's about kind of half where it was over the kind of long-term average. So that is a concern. What about housing supply? Who is building these homes? This is a great graph that goes back to sort of 1950, and it shows that between 1950 and sort of 1980, it was local authorities that were doing most of the building. They kind of petered off into the 90s and were non-existent, didn't do any more building. And then we had kind of housing associations tried to pick up the slack, but just was stagnant in a very small proportion. And then it was majority from about the mid 80s onwards, the majority was actually private housing. And so that's a good indication of where trends have gone, but it is quite concerning. And we would love local authorities to start building a bit more, please. And here we've got a bit of information about who actually owns these properties. So the amount of properties that are owner occupied, rented from private registered providers, rented privately, rented from local authorities, rented from other public dwellings. And so you can see an awful lot is obviously owner occupied. And the next big growth is private rented. That's grown quite a bit over the last 20 years. It's probably doubled, maybe even close to tripled. And renting from local authority over the same time has proportionally gone down. So what we can see there, no surprises, private landlords have picked up the slack from local authority. So, what about construction materials? Well, look, we had kind of over COVID, inflation of construction materials went absolutely nuts. It kind of some years going up almost 30%. It's actually reduced the last couple of years, so growth has been kind of stagnant, almost just a little bit negative, which is good. But remember, if we're looking over 5 years, because that growth was so monumental over COVID, that actually it is a lot higher than it was. So if you're building, it's good news for the last kind of year, 2 years. Bad news compared to where it was over the last five. And labour. This is such a great graph. It shows that over 500,000 UK-born construction workers expect to retire by 2032. Okay, so that is a massive proportion of them are expecting to retire. Now, the issue we've got is no one is coming in from the grassroots and doing these apprenticeships and things like that. And it's a real shame. We need to encourage people into the construction sector. We've got to make it, I don't know, Instagrammable. Get everyone to stop being yoga teachers um, and influencers and start being construction workers. There's good money to be made in it. So, yeah, we've got over 500,000 are retiring. No one's taken their place. We've had issues with Brexit, with construction workers going back to sort of Eastern European countries, and no one really has been coming in to take that spot. So that is an issue. We do have an issue there, and that is keeping costs very high. So, but on the demand side there, we talked about the supply. Now, how about the demand? So, in the census of 2023, we had about 28.4 million households, which was an increase of 7.6 over the last 10 years. 8.4 million people living alone in the UK. So household growth is growing because households are getting smaller. Things like divorce, but also the big thing is people are living longer. And so going into care and things like that being kind of split up. So that is really affecting the amount of households we've got. 30% of all households and 13% of all people living in households are on their own. Okay, so a bit depressing that, isn't it? 2.3%, sorry, 2.36 is the average amount of residents in a household. That's grown very slightly over the last sort of 10 years, over the last 50 years, yeah, a little bit more. Um, 200,000 new households are formed every year, but that's rising by about 0.6% a year based on the last 5 year average. So looking at year on year, over the last 5 years, on average, it's growing by about 0.6% a year. So, yeah, we are growing as a household, as a bunch of households in the UK. So, what can the government do? Well, they can use the carrot instead of the stick to encourage investment. They can ease planning or tighten it. They could ease tax or tighten it. They could ease legislation or tighten it. They could ease bank legislation or tighten it. Now, whatever they do, we're not in control of, but what we can control is our reaction to it. Now, the good thing about when they tighten these things is it creates a big barrier to entry. And so that allows those people within the market to start picking up a bit more market share. So, look, it's not all bad. There's opportunities everywhere. We just need to kind of look at it. I mean, easing planning, they're talking about it. Let's see what happens. Easing tax, no, that's not going to happen. We can see that that's going to be tightened. Unless maybe they do something with stamp duty. Hopefully they would, but I can't see it happening. Easing legislation, I mean, depends where. Maybe on the planning side. Ease bank legislation, yeah, they seem to be doing a little bit of that, so possibly, yeah. Okay, so what should you be concerned about as an investor in property? Well, other staples of living can increase disproportionately for our target market. So, if we are renting to the lowest sort of 10% of household earners, okay, what we can see is back in kind of 2020, energy prices for those earners went from 7% of their income to almost 20%. Whereas for the top 10% of earners, it went from about 2% to about 2.2%. So it has a disproportionate effect on the lower value ones. Whereas on the other end of the spectrum, higher earners are being more impacted by tax. So again, it's just looking at your target market. What's going on with the other staples of living and tax and things like that? Affordable demand, okay. Is your target market, are they able to afford it? Okay. Follow the household net income. So important. Household net income. Price pricing rents over a fixed period. So I don't know, doing a tenancy for 5 years at a fixed price that are not going to go up with the market. When you've got an inflationary market, you're putting yourself at risk there. Illiquidity, we hear lots of nonsense about kind of make all your cash work. Don't make all your cash work. Keep some of it kind of as dry powder. Um, Look at how much of your debt is exposed at a specific point in time. So if you get a portfolio mortgage, it's all going to come. You don't want it all to kind of you to need to refinance in 2008. You might be sort of really stuffed. So again, keep an eye on that. So as a property investor, your job is to find mispriced investments. That is the key for you there. So, what can you be tracking? You can be tracking debt servicing as a percentage of rent. Okay, how much is your debt costing you as a percentage of your rent as a whole? Now, lettings costs as a percentage of rent, your maintenance costs as a percentage of rent, and other costs. So, other costs might be things like your insurance, your cost of business. So, I don't know, your accountancy fees, running the business, your office space, all that sort of stuff. Yeah, because it all matters. It's all about the revenue or rent. And then the percentage of your tenant's household income that's spent on rent. Because again, if your target audience is becoming unaffordable, it's going to lead to more problems. Weighted average cost of debt, big one. Yeah, we want to know what's going on with all your debt. You've probably not got portfolio mortgage on everything. Hopefully, you've got different mortgages at different times, different rates. So, what's the weighted average cost of debt? Your net income as a percentage of rent, that's a really obvious one, but so important. Looking at your total debt, so your loan to value of all your debt, so that's secured and unsecured. Lots of people have maybe bounce back loans, they might have kind of private investment that's not secured or even secured by other means. Total debt, let's have a look at that. And look at your releasable equity. So if you sold today, what actually would you get in your pocket after taxes and paying sort of early redemption fees and all that sort of stuff after your agent fee? What are you going to get in your pocket? Because that allows you to kind of look at what those what you can look at it against other asset classes in the now. And then also total returns over time. That's a big one. Time is massive, and that feeds into things like internal rate of return, so IRRs, CAGRs as well, compound annual growth rate. Massive for property investors. And if you came to our last workshop, you'll know all about that. So again, we've got our next one-day property business workshop, myself and Adam Lawrence, 22nd of January in London, Blackfriars. It is all about productivity for the new year. So hopefully you'll have done Christmas and you'll be raring to go in January. Please do get your tickets. They are going to sell out. These are always sell out events. They are fantastic. We have a great bunch of people in the room. There's always good networking too. It's full on. It's a full on day. 9 to 5, no holds barred. It's a workshop style, so you will be kind of working tables and things like that. And it's on productivity and financial understanding. So again, with SMEs, one of the big issues we see is kind of books and accounts all over the shop. And if you haven't got your books in order and don't understand them, it's so hard to create a platform from which to grow. So we always talk about the boring stuff that no one else wants to talk about at these workshops. We get you in there, you can't escape, and then we can tell you all the boring bits. But you really do need them if you want to grow a business. Okay, so hopefully we'll see you there. I'll stick links in the show notes. Hope you enjoyed it. If you did, please whack a review on wherever you watched it, either YouTube, give us a thumbs up, write a comment. If it was somewhere else, just let other people know. If you didn't like it, just let me know. Don't tell the world. Okay, thank you and goodbye.